Hello everyone, this is Doc from the Wealth Boardroom. Welcome to our channel. Today we're going to dive deep into the world of student loans and their profound implications on financial stability and generational wealth. Student loans have become a prevalent part of the educational journey for many. As the cost of education continues to rise, an increasing number of students are turning to loans to fund their academic pursuits. This has led to a significant financial burden for many individuals, with millions of people grappling with debt long after their graduation. This isn't just an issue about paying for school, it's a topic that touches on broader financial health, future prospects, and yes, even the accumulation of generational wealth. So that's the stage we're setting. We're not just talking about money borrowed for a degree. We're discussing a financial instrument that has far-reaching implications on personal and familial wealth. As you can see, student loans play a pivotal role in many people's lives. But what impact do they have on generational wealth? Generational wealth, the wealth that is passed down from one generation to the next, is a crucial aspect of financial stability. It's the bedrock on which families build their financial future, a buffer against unexpected hardships, and a stepping stone to greater opportunities. But what happens when this wealth building is interrupted by a common financial burden? Student loans. Student loans are a significant investment in one's future, opening doors to education and career advancement. However, they can also become a heavy burden that hinders the accumulation of wealth over time. Imagine a young graduate full of potential, stepping into the world only to be weighed down by the immense pressure of student debt. This debt can take years, even decades to pay off, during which time it eats into their ability to save, invest, and accumulate wealth. The impact of student loans becomes even more pronounced when we examine its interplay with socioeconomic disparities. Often, those from lower income backgrounds rely more heavily on student loans to finance their education. This means they start their post-education life with a higher level of debt, which can significantly delay their ability to build wealth. This disparity can contribute to the widening wealth gap we see in society today. But it's not all doom and gloom. Recognizing the impact of student loans on generational wealth is the first step towards addressing it. There are strategies and policies that can be employed to alleviate the burden of student loans, which we will delve into later in this video. To wrap up, while student loans serve a necessary purpose in financing education, they can also pose a significant hurdle to wealth accumulation. This issue is particularly pertinent for those from lower socioeconomic backgrounds, who may depend more on student loans and thus face a steeper climb to financial stability. Student loans, while vital for education, can potentially become a roadblock to wealth accumulation. The challenge is to find a balance between investing in our future through education and ensuring that this investment doesn't hinder our long-term financial stability and ability to build generational wealth. Your credit report is a critical component of your financial health. It's like a financial report card that lenders, employers, and landlords use to evaluate your credit worthiness. And guess what? Your student loans play a significant role in shaping this report. Let's start by understanding how student loans end up on your credit report. When you take out a student loan, your lender reports the loan details to the credit bureaus, who include it in your credit report. This happens whether the loan is federal or private. As you start repaying your loan, your payment behavior also gets reported and becomes a part of your credit history. Now, you might wonder, how does this repayment behavior affect your credit score? Well, it's pretty straightforward. If you consistently make your student loan payments on time, it will positively impact your credit score. On the other hand, if you miss payments or default on your loan, it can significantly lower your score. But here's the catch. Student loans are installment loans, meaning you borrow a lump sum and pay it back over time. Unlike a revolving credit, like credit cards, where maintaining a low balance boosts your credit score, the size of your student loan doesn't directly affect your score. It's all about your payment history. So, what about the long-term effects of student loans on your creditworthiness? Well, student loans can stay on your credit report for a long time. If you're timely with your payments, the loan stays on your report for 10 years from the date you pay it off. If you default, it can haunt your report for 7 years from the date of the last missed payment. In essence, student loans can be a double-edged sword. On one hand, they can help you build a strong credit history if managed responsibly. On the other hand, they can drag down your credit score if you struggle with repayments. Student loans can have a significant impact on your credit, which in turn affects your financial options in the future. So, it's crucial to understand the relationship between student loans and credit reports. After all, your financial health is at stake, and you hold the key to maintaining it. Buying a home is a significant financial milestone, but student loans can complicate this process. When applying for a mortgage, lenders assess your financial health by looking at your debt-to-income ratio, or DTI. This ratio is calculated by adding up all your monthly debt payments and dividing them by your gross monthly income. The result is a percentage that lenders use to gauge your ability to manage the payments you make each month. An ideal DTI is generally around 36% or less, but here's where student loans enter the picture. These loans are considered part of your debt and therefore contribute to your DTI. If you've taken out substantial student loans, your DTI might be high, making lenders more hesitant to approve your mortgage application. Now, you might wonder, why does a high DTI matter? Well, a high DTI signals to lenders that a significant portion of your income is tied up in debt repayments, leaving less room for additional debt like a mortgage. This could make you seem like a riskier borrower. The challenge here is that student loans are often necessary for people to pay for higher education, but they can become a barrier when it comes to qualifying for mortgages. The reality is, having student loan debt can delay home ownership, which is a key component of wealth accumulation. But let's not lose hope. If you're grappling with student loans and dreaming of buying a home, there are strategies you can employ. Paying down your student debt as quickly as possible can help reduce your DTI. Additionally, some mortgage programs are more lenient with higher DTIs, especially for first-time home buyers. Remember, knowledge is power. Understanding how student loans impact your DTI and your mortgage eligibility is a crucial step in navigating the path to home ownership. Student loans can make the dream of home ownership more challenging, but not impossible. Bankruptcy can provide relief from many types of debt, but student loans are a notable exception. This is a result of a complex legal framework that makes it exceptionally difficult to discharge student loans in bankruptcy. The standard applied by most courts is called the undue hardship test, which is a challenging threshold to meet. Indeed, borrowers seeking relief from student debt through bankruptcy often face a daunting journey. They must demonstrate that they've made good faith efforts to repay the debt and that they're unable to maintain a minimal standard of living if forced to continue repayments. Moreover, these challenges don't just evaporate if the bankruptcy case is unsuccessful. The lingering student debt can exacerbate financial struggles, making it harder for individuals to regain their financial footing. In turn, This has implications for the accumulation of generational wealth. The non-dischargeability of student loans in bankruptcy can prolong financial hardships and impact generational wealth. The burden of student debt, in essence, can echo across generations. While the challenges are substantial, there are ways to manage student loan debt and minimize its impact. Let's delve into the strategies for managing student loan debt and mitigating its effect on creditworthiness. Firstly, it's essential to keep informed about your loan. Understanding the terms of your loan, the repayment schedule, and the interest rates can help you plan your financial future more accurately. Secondly, consider making payments while still in school. Even if it's a small amount, it can make a significant difference in the long run by reducing the overall interest accrued on your loan. Thirdly, take advantage of loan forgiveness programs. Certain professions, like teaching or public service, may qualify for loan forgiveness. It's important to research and apply for these opportunities. Now, let's pivot to policy recommendations that could address the student debt crisis and promote wealth-building opportunities. One such policy could be the introduction of income-driven repayment plans. These plans cap the monthly loan repayment at a percentage of the borrower's income, making repayments more manageable and less of a burden. Another policy could be the expansion of loan forgiveness programs. Broadening the criteria for these programs could help more individuals qualify for loan forgiveness, reducing the overall student debt load. Lastly, we must emphasize the importance of financial education and empowerment. Financial literacy is a powerful tool that can help individuals understand their financial situations, make informed decisions, and ultimately reduce the impact of student loan debt on their lives. Financial education can include understanding budgeting, the importance of saving, and the impact of interest rates. It can also involve learning about the different types of loans, their respective benefits and risks, and how to manage debt effectively. In conclusion, mitigating the impact of student loans on generational wealth is not an impossible task. It requires a combination of individual effort, policy changes, and financial education. Remember, every bit of effort counts, and even small changes can lead to substantial results over time. Addressing student loan debt is critical for promoting financial stability and generational wealth. Student loans are a complex issue with far-reaching impacts. We've delved into how they can impede generational wealth, affect creditworthiness, and create barriers to home ownership. But remember, there are strategies to manage these challenges. It's a matter of understanding the system, seeking financial education, and advocating for policy changes. Thank you for joining us today. If you found this video helpful, please subscribe to the Wealth Boardroom for more insights into financial stability and wealth building.